Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at Tasty Live. Welcome to the show. We are in the full of another big macro release here. We've been back and forth on this debt ceiling, back and forth on the banking crisis, of course, over recent weeks, back and forth on a whole number of out there one-off risks, but we are seemingly back to what is a more macro, a more rates-oriented, a more fundamentally big picture narrative in these markets. And of course, that puts the spotlight on the U.S. jobs report that is going to be with us here as the week winds up. And as we unpack what it's likely to do for markets, I think it'll be useful, of course, to take a look at where we've been, take a look at what the influences have been on these markets in recent weeks, so how this sets up. And so depending on what comes out, how it will influence stocks, currencies, commodities, and major assets writ large. So I want to start here actually with a look at what happened today and the influence that we've seen manifest from data or non-influence, for that matter, around the key markets and the narrative they're in, and so how that shapes our lens going forward. So what you see in front of you here is the price action that we saw today, and if you look at the time scale on the bottom, that's GMT. I tend to default to GMT because it's a steady time reference. There's no daylight savings changes or anything like this. So note what you're seeing over the course of today. The three lines going down, the purple is the 2-year U.S. yield. The sort of light turquoise there is the December 23 Fed funds future implied rate. And in the green is the U.S. dollar, in this case, the U.S. dollar index. You can see them moving in tandem starting from overnight, about 2-3 a.m. Central is, I think, the conversion there. But you can see right around 7-8 GMT is when that turn starts to happen. Notably, at the same time, you see a rise in gold, and you see a rise in NASDAQ futures relative to the S&P. So the more rates-sensitive U.S. equity index outperforming in tandem with what's going on here, the kind of catch-all benchmark. I think if we were to take a look at the performance of, let's say, even within sectoral ETFs, something like the tech relative to benchmark or communication services relative to benchmark, you could see a similar thing. And what this seems to speak to is a generalized move toward a reduction in Fed policy expectations on the hawkish side, and a kind of dovish shift in the overall structure, which is how you get yields lower. It's how you get the implied Fed funds rate for the end of this year lower. It's how you get the dollar lower. Not surprisingly, it's how you get gold higher, because, of course, gold is a foil for both yields and the dollar. It is a non-yielding alternative to fiat currency, alternative to paper currency. And so, in so much as declining yields and a weaker dollar make alternatives to those things more attractive, gold is not surprisingly higher as well. The key thing for me here seems to be that this is happening long before the data actually starts to cross the wires from the U.S. side of things. So jobless claims, ADP, the ISM manufacturing index, all those things happen later. And they do seem to have an influence, but that influence seems to be to amplify moves that were already there or to undercut them. It does not seem to be defining. So you can see here, for example, as jobless claims and ADP come out. ADP is a little bit better than expected. So as it hits here, you can see gold declines into it, stocks decline into it. The Fed rate hike outlook gets a little bit more upward focused for a bit. The dollar goes higher a bit. Yields go up a little bit. That's this right here. Then jobless claims come out and they're baseline worse than expected, albeit by a hair. ISM manufacturing comes out and it is weaker than expected. So what you see here is a reaction once this kind of data release period comes out. All through here is more of what you saw all through here. So the data really just creates a bit of volatility back and forth. You can see as ISM comes out and it's worse than expected, you initially get a dip in stocks, but then they rise. Dollar keeps going lower. Yields keep going lower. The Fed outlook keeps going lower. Gold wobbles for a bit and then goes higher, notably with stocks. So if you have any ideas yet about gold being a safe haven, let those be put to rest here. And again, this is not just stocks in absolute terms. This is NASDAQ relative to stocks. So this is yield sensitive stocks relative to benchmark. And you can see exactly the synchronization here. So it's almost as if the data was a kind of thing to get through so that the larger dynamic could continue. And that larger dynamic is the unwinding of some of the recent hawkishness in Fed policy expectations. Note that here. So over the course of May, as we've talked about, Fed rate cut expectations have been meaningfully reduced. So you can see here, you were at the start of this month expecting anywhere between 175 basis points in cuts in the back half of this year. The red line here is the rate expected for Fed funds in December. The blue line here is June, and the gray bars are the difference between the two. You can see that the gray bars narrow as these lines get closer, which means that rate cut expectations for the back half of this year are being reduced right here. You can see the upshot starts being that you go from a rate at the end of this year at about 425 to now something closer to 475 or 5. In other words, you've gone from expecting between 175 basis points in cuts here to now expecting about 25 basis points in net cuts. But what you'll notice is that after this adjustment runs its course, you start to see it widen back out again. So this is rate cuts narrowing. This, over the course of this week, the 5 days that are this week, you see a bit more moderation. So a bit less hawkish. Now, naturally, the question starts being, well, why is that? Take a look at the curve. What you're seeing here in the solid line is where the curve is currently. In the dotted line is where it was a week ago. And in the dashed line where it was at the beginning of this month. So you can see the curve is a little bit more hawkish overall than it was at the beginning of May. which is when the Fed delivered its last policy announcement on the 3rd, but it's actually a little bit flatter as relative to last week. The difference seems to be that all through May, we talked about this in detail on Macro Money yesterday, we saw the unwinding of risk linked to the debt ceiling as a fiscal headwind. I've made the argument here before that to price in actual U.S. default is a ludicrous thing because you cannot have the markets as we know them today if there is any kind of reasonable, meaningful, actual concern about the faith and credit of the U.S. government. Because over 80, close to 90% of global monetary transactions are done in the U.S. dollar, and the U.S. government bond, the U.S. Debt instrument, is the risk-free benchmark asset for essentially the entirety of the financial universe. The Treasury is the risk-free asset in virtually every portfolio, in the construction of virtually every set of derivatives, the baseline for options pricing. It goes on and on and on and on. If you lose the faith and credit of the U.S. government and therefore fundamentally undermine the pillar of the current system that is the U.S. Treasury bond in portfolio construction, in asset construction, and you undermine the dollar, which is the transactional currency to make everything move around, well, then you don't have a financial system as we know it. You have something else entirely. But in the system as we have it, as it is given, there is no right price for a U.S. default to be priced into, let's say, the S&P or gold or the dollar. What you'd have to price in is the demise of the system itself. So what was being baked into markets, arguably, and what actually was a functional object of speculation was the fiscal implications. Would we get a bunch more spending cuts, which would hurt growth? Would we get some degree of tax hikes, which might hurt growth? And would policymakers overstay past deadline, meaning the Treasury would have to actually pause some spending, which would be a hit to growth? Government spending is one of the inputs into GDP. So I think that was really the question. And then the more disorderly the situation looked, the more it looked like there might be a bigger hit to growth, and the Fed might need to do more to offset it with more aggressive cuts in the back half of the year. It seemed like we spent most of May suggesting that this was not going to be a meaningful fiscal risk. And that's why these offsetting rate cut expectations got so hemmed in over the course of May. This is why that red line that you see in front of you there was going up in May, narrowing scope for rate cuts. Because that fiscal gut punch that the markets were afraid of as a consequence of whatever this debt ceiling deal was going to be, that seems to have gone away over the course of May. And then over the course of the past week, what we seem to have is a kind of buy the rumor, sell the fact dynamic, where now that the deal is all but done, it's been agreed, it's passed the House, now it just needs to clear a last hurdle in the Senate where arguably things are easier to get done in this sense. You have a situation where the markets are adjusting back the other way. And rates have shifted lower as relative to even a week ago. If you look at where we are in overall policy expectations, you can see we now see a very meager 24% chance of a hike in June. It was almost fully priced in at the beginning of this week. Now, not there. You have a little bit more of a probability for July at 38. And if you add those two things together, then you get about a 63% chance of a hike sometime between now and July. And you can see that right here. And you can see that comes from adding these two things together. So what you see is, relative to where rates are currently, by July, you have baked in 63% of a hike. And if you add these implied rates together, what you are essentially looking at is just over 20 basis points, 21.7 basis points to be precise, baked in out of a 25 basis point hike. So that's how you end up with what you are seeing here. Now, that is, of course, a far cry from a rate hike being fully baked in as of the beginning of this week. And you can see that in this chart yet again. So going back just about a week ago, you can see right here, this was where we were supposed to end the year, and now we've seen a bit of an adjustment. It's starting to adjust back down. So, as far as rate cut expectations, what you now see is, at this point, perhaps a slight chance of a hike, maybe even slightly better than even at 63%, but certainly not something that was as convincing as it looked at the beginning of this week. And then a view to cuts. So come November, there seems to be a bit of an expectation that you're starting to veer in that direction. But if you look at the implied rate delta column, the changes are still very small. You have the first cut almost fully priced in for December. So you can see down 24 basis points there. And then come January, you're almost down 50. So come January, that hike is fully there, or the cut, rather. And there's a 75% chance of a further cut by then. So consider here almost a full cut priced in, 0.94. That's how you get 0.236 here, so almost the full 0.25, almost the full cut, almost one here. When you get to January, that one cut is there, and there's a further 76% of another cut that's being priced in. You can see this is seen as down 44 basis points out of the 50 that would be consistent with two full cuts. So this is now a meaningfully dovish shift in policy expectations just over the past several days, which arguably explains what we've been seeing. And the influence, as we can see from looking at the price action, seems to be more so the passage of the debt ceiling deal overnight in the House than anything that was influenced by economic data. It seems more a buy the rumor, sell the fact kind of dynamic as linked to the debt ceiling deal and the fiscal implications of it. And then, of course, the monetary policy knock-on from those fiscal implications, than anything that jobless claims or ADP or the ISM number had to do with it per se. Now, why is this adjustment happening in the first place? Well, we talked about this in detail yesterday, and it's the idea that the markets expect economic pain ahead, that it's not all smooth sailing now that we have the banking crisis, I dare say, in some kind of a remission, although we might certainly get more failures along the way. And the debt ceiling deal seemingly, at least, off the radar until after the election next year. That's the structure of this deal here, that it essentially raises the debt ceiling until whatever the next administration is dealing with it. So what you see is that while CPI and PCE inflation at the headline numbers is now 4.4, 4.9%, so closer to 5, the 2-year break-even rate is at 2. So the market, in this case the bond market, is basically saying over the course of the next 2 years or so, what we're going to see is the disinflation of the economy from 4.4, 4.9 down to 2. And the question is, well, how is that going to happen? But where are you going to get that disinflation? Well, one school of thought, and certainly the one that the Fed toyed with in 2021, was that this inflation is a transitory thing and that with the normalization of supply chains, it will go away. And that's been in part right, but also in part wrong, which is how we have the rate hike cycle that we are now faced with after almost a year of breakneck tightening. In the bars there, what you see is a benchmark for shipping costs. That's the Baltic Dry Index. You can see it's been falling since the second half of 2021 as supply chains were becoming normalized. You also have in the red the year-on-year growth rate in distributive costs, so the costs to get goods moving around for intermediate goods and for final goods. For intermediate goods, it's the moving of parts around. So think about the building of cars, where some parts are made in Mexico, some parts are made in the US, some parts are made in Canada, some parts may be made in Taiwan or Korea or China, and they are constantly moving around from value add center to value add center, where a little bit more work is done and then shipped on, and then a little bit more work is done elsewhere and then shipped on. And then what you end up with ultimately is a finished car at whatever factory, and it is then shipped to where it's going to get sold. That would be the final year-on-year growth rate. So it obviously costs to get that final finished thing from where it got finished to where it's going to get sold. And you can see that the distribution costs for both intermediate and final goods have now declined to levels that are even lower than they were before COVID. They are at this point at COVID lockdown depths. So there's arguably not much more to get squeezed out here. Instead, the disinflation is likely to come from addressing this mismatch in the labor market. And indeed, we can see here that looking at the job openings data that we got just this week, it pointed to the supply-demand balance actually getting a little bit more pronounced over the past month as opposed to less. So what you see here, as inflation starts to perk up, you see a very significant imbalance in supply and demand for labor, where supply is outstripping demand. And this is, of course, because of COVID lockdowns, because people have been laid off, because people are sitting at home. So there's lots of labor supply here being the number of people in work and the number of people able to be in work. So this is the labor force. The demand is the number of people in work plus job openings. So the number of people that companies want to be employing. And what you see is that during the COVID period and the lockdowns, obviously, the number of people that companies want to be employing collapses, whereas the number of people able to be employed relative to that is up. And so here, through the heart of COVID, you see labor oversupply as relative to demand. As the economy starts to reopen, that works its way down. And of course, at the same time, inflation is going up. And now you are left with the opposite scenario. You now have more labor demand than you have supply. And that, of course, shows up in wages. The only way that companies are able to compete for scarce labor is by paying more. This is the part of the equation that isn't a transitory one, because wages don't just adjust down when goods inflation adjusts down. They get baked in. Employment contracts generally don't get revised down for inflation. And so this is the part that the Fed is hoping to address by slowing economic activity, by essentially forcing the rest of the disinflation that they want to have from the peaks that we see here down to 2%. And as we just said, looking at the break-even rate here, the market believes them. The market thinks they will be successful. Now, of course, the only way to affect this squeeze is slowing economic growth. But as we just said, what we saw in the JOLTS numbers just this week, you can see that right here, we actually have a little bit of a move in the wrong direction here as far as the Fed is concerned. There's actually a bit more of a dislocation. Looking at the ISM numbers that we got this week, it's a similar story. Note, the overall manufacturing index down from the previous month. New orders down, so there's the slowdown in economic activity. The pressure from costs down, but employment actually going up for a second consecutive month. And indeed, the only aspect of this manufacturing story where you still have positive growth, recall ISM works in the logic of PMIs, and so above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go under 50, the faster the contraction. Employment is the only component here that's growing. New orders are down, and the price index is down, and the overall index is down. But employment is on the rise, similar to what we see reflected here. This, of course, sets up interesting expectations for what is going to happen in the official numbers. In the green there is the monthly change in non-farm payrolls. You can see the expectation there is for a slowdown to create 195,000 jobs in May. That would be the lowest number that we've seen since the second half of 2020. You can see some of these recent bottoms here: 286, 254, 239. 195 would land us somewhere over here. So just under this 200 mark. So somewhere right there. On the unemployment rate, it looks like we're still expected to hold very much within the recent range. You can kind of ballpark the recent range as being between about 3.7 and 3.4. And you can see we've kind of flatlined here. At 3.5, we're expected to register right in the middle of that range. Now, if what we saw here and here holds up, well, then we might expect that there could be some positive surprise factor here. If that's the case, then the question is, have the markets overcorrected now on their Fed policy expectations? The possibility that we would get an upside correction, seemingly reinforced by this Citi Economic Surprise Index, which is a tracker of how data outcomes register relative to forecasts. And what we see here is that over recent sessions, it has actually broken through its 20-day moving average and now seems to be on an incline. Recall what happened when this was the story back in February. This was consistent with rising policy expectations, with stronger yields, and with what ultimately became a sharp enough rise in borrowing costs that SVB suffered a bank run, and we saw the knock-on effects of that. We're back in a similar kind of situation. It's not as aggressive here, but it might be starting to go in that sort of a direction, in which case we might have an upside surprise on this. And if that's the case, well, then maybe we get the flip of this dynamic. If this is the readjustment, basically reflecting the fact that debt ceiling aside and banking crisis aside, there's an economic slowdown ahead that is going to make this right here make sense, that is going to erase the gap between inflation at 4.4, 4.9 and expected inflation at 2, and that's how we're going to do it. It'll be through economic slowdown, which ostensibly means we don't need more aggressive rate hikes, and that's why that's the response after the debt ceiling is resolved that we see as markets normalize. Well, then if we get a better than expected jobs report, then we might instead be looking at something that looks more like this here. In which case, the pullback that we then see right here might get adjusted away a bit, which should, if the numbers comply, flip this on its head, whereby yields, policy expectations, and the dollar rise, gold declines, and we'll of course see how shares do overall, but in relative terms, it seems like the NASDAQ might stumble a bit as relative to less rate-sensitive averages. And that is Macro Money for today. Thank you very much for joining me. I'll be on Futures Power Hour tomorrow with Mr. Chris Vecchio, who returns to the till, and we'll break down the aftermath of NFP and what all actually happened across markets in its wake and test our theory here. We come back for Macro Money as well as Overtime at the beginning of next week. Those shows run Monday through Thursday. I'll also be on with Tom and Tony for First Call on Sunday, as per the usual. Outside of the shows, I am opining on Twitter at Ilias Pivac. Thanks very much, everybody. Good luck out there. Godspeed.